question looks a little difficult because there's a lot of data available to the question, but it's not as such a very difficult question. So if you look around, basically they have given you the details of, they have made you four accounts: furniture and equipment, motor vehicles, and then their respective depreciation. And the similar data is available in a schedule kind of a form. Like they have given you the opening balance, and then if you notice, this is the that's the opening balance. Then whatever is added or subtracted from that, that gives you the closing balance. And then similarly with the rest of the values, with the rest of the accounts. So now coming back to how exactly can you do this question. So the first thing that they have, all right, then after this, these are all the transactions that have been given which happened during the year. So technically this kind of data, this data and the previous data, that gives you the closing values, and this is the data that is going to give you the adjustments over the year, and then closing values of the previous year plus minus the adjustments given on this year, and will give you the closing value of the current year, right? So moving further, let's say we have to make all the accounts actually. So we have to make furniture and equipment account, we have to make motor vehicles account. Let's just discuss it one by one. The balance, or let's make the furniture account first. So the balance on the furniture account is 2970, and the provision for depreciation balance is 897. Okay, let's talk about the adjustments now. So in terms of furniture, there's new furniture purchased for 80,000. This is what I can see from here. And then there was equipment. Oh yeah, furniture and equipment is the same one. So then one equipment bought for 540, one for 80, and another one equipment which had been purchased on this for this is, alright, this was sold off. So this equipment that says on 3rd September 2008, equipment which had been purchased on 31st March for 300,000 was sold, right? So this is the cost of the equipment that was sold off, right? So let's move to the account now. The opening value of the account was 2970. So let's make the account brought down of 2970. Then there was purchases of 540 and 80. So 540,000, 80,000. This is 1st June, and this is 3rd December. Okay, I think nothing has been written here, so I'm assuming that they were paid through bank. Yes. And then the other one was sold on September 3rd for, I would say, disposal, because I'll take it to the disposal account. This is for 300,000. So let's find out the closing value. The closing value becomes, this is 3590. 3590 minus 300 gives me 3290. This is my closing value. Okay, let's move to the vehicles part. It says that on 1st February 2009, three new motor vehicles were purchased for 80,000 each. On the same date, a vehicle which had cost 56,000 on 15th May was sold for 20,000. Okay, so let's make up this account. I need the opening values first. The opening value for motor vehicles is, opening value becomes this 1800. And if I want to see from the account also, so let's go to the account of motor vehicles, and this is my carried down balance 1800. Okay, let's go to the account now and let's make it up. So brought down 1800, additions from probably bank only, purchase 80,000 each on the same, yeah, okay. So it's not written that they haven't paid it through bank, so I'm assuming that they have paid it. So 80 multiplied by 3, so this makes 240, and the one that was disposed of was basically for 56,000. Let's balance it off. 1800 plus 240 gives me 2040, and 2040 minus 56 will be 1984. So my closing balance is 1984,000. Okay, let's move to the depreciation part now. So first thing first, we know, let's read the depreciation policy. So it says that a full year depreciation is provided for all fixed assets in use at the end of the financial statement. So whenever a depreciation is applied for all the assets at the end of the financial statement, that would basically means that the depreciation is applied on the closing figure. Okay, but the problem here is that we don't have a depreciation percentage. We need to calculate the percentage, and it says that the rate of depreciation applied on the cost for the year April 2008 continue to be then applied for 2009. So what I can do here is that I can actually check the previous year balance to identify that what depreciation percentage is applied. So let's check it out. Let's see. The closing balance for furniture and equipment was 2970. Okay, sorry, was 2970, and the depreciation applied for the furniture and equipment was 297, right? What do I need to do? I just need to find out the percentage. So I would say 297 upon 2970 multiply by 100. This gives me 10%, right? वैसे तो you can see it clearly, but it's still 10% if you have to calculate. Let's talk about the other one. Let's talk about the motor vehicles account. Again, the closing balance 1800. The depreciation applied, because see it says profit and loss, that means this is the depreciation applied. Same was here also. So 450 upon 1800 multiply by 100 will give me 25%. So now we've seen that for furniture and equipment it's 10% per annum on the closing value, and on motor vehicles account it's 25% of the closing value. Okay, let's solve it out now. If you want to know why have I applied it on cost and not net book value, or where do I get my method from, like whether it's straight line or reducing balance method, then you can clearly read it from here. It says that it is applied on cost, so that is why I have taken the balances of cost and not the net book value. Okay, let's move further. So now my depreciation has to be applied on, let's calculate the depreciation first. So 3290, 10%, this gives me 329, and 1984, 25%. So this gives me 1984 into 25% will give me 496. This is my income statement balance. Let's make up an account first. So if I make an account, I know that the provision goes, the brought down will come on this side, right? There has to be the income statement balance, then there has to be, which is of course 329, right? Then there has to be a closing balance, and there is to be a disposal also, because in both the cases one piece has been disposed of. Let's find out that depreciation first. The opening value of the depreciation could be seen from here. It was 897. Okay, so I'll just write it down in the account. Let's talk about the first one. It says that on 3rd September, here I am, where the value has been, the asset has been disposed of. The asset was purchased for 300,000, and it was purchased on 31st March 2006. Right now we are standing on 30th April 2009. Let's find out the number of years. So 31st March 2006, the first year ends on 30th April 2006, then 2007 April, then April 2008, and then 2009. Since it says that no depreciation has to be charged in the year of disposal, we are only charging these 3 years. So when I say 3 years, that means 300,000 multiply by 10% multiply by 3 years. This gives me 300,000, rather 30 multiply by 3. So this gives me 90,000, right? This is the disposal value. Okay, let's move on. The disposal will be 90,000. So 90, and now I can have my closing value. So 897 plus 329, 1226, 1226 minus 90, my balance becomes 1136. Okay, so this is my closing balance for provision for depreciation on furniture and equipment account. Okay, let's make this one where provision for depreciation on motor vehicles. Let's find out the opening value for motor vehicle. The opening value for motor vehicles account would be 840. Okay, let's go to this account, start making it brought down. 840. The depreciation that we have calculated was, wait, I'll just go back and check. That goes to income statement. There has to be a disposal value and there has to be a carried down value. Okay, so let's find out the depreciation. The depreciation was, okay, I removed it from here, but the depreciation was 25% of 1800. So it was, you can just reverse the video a little bit and identify कि कैसे निकाली थी. That became, let me check, sorry, it was 1984 and 25%, that was 496. So 496, right? Next thing, we have to go for disposal. So for the disposal amount, let's do it now. The asset was disposed of for I don't know what, but it had cost 56,000 and it was purchased on 2005 May. Alright, so if I bought it on May 2005, that means my first year would end on April 2006, then 2007 April, then 2008, and of course I will not charge anything for 2009 because this is my current year and the asset has been disposed of in this year. It says that no depreciation is charged in the year of disposal. Okay, so again 3 years multiply by 25% of what? 56,000. So what is the value here? 42,000. Okay, so going back, 42,000 goes to disposal. Okay, sorry, we are just writing values in without thousand. Okay, so my closing value becomes 1294. One three three six 1336. For the disposal account, the asset disposed of, the furniture that was disposed of was for 300,000. Sorry, again I've written thousands here. Was for 300. The disposal depreciation charged was 90. So provision 90. Okay, how much was it sold for? Let's go back and check it out. It was sold for 132. So in bank I receive 132. So obviously there is going to be loss on disposal. Plus 90, 300 minus answer gives me 78. Okay, for the disposal of motor vehicle, the cost was 56. The provision charged was 42. I don't know where does the income statement come, but what is the value of the asset? Let's go back. 1st February 2009, 3 new motor vehicles were purchased. On this business, the motor vehicle was sold for 20,000. Here I am, 20,000. Coming back to it, so I sold it for 20,000. That was bank. Oh, this is the heavier side now. So this becomes 62. 62, that means there is gain on disposal of 6,000. Okay, so there was gain here and there was loss here. Okay, I believe the question is done now and you'll be able to do such questions, because the question wasn't that difficult. It's only that you had to read the value from either this portion or this portion. Both of them have been clearly taught to you.